Real estate has gone far beyond affordable in many cities around the world. This has created a hyper bubble like we have never seen before. People are so heavily burdened by debt, but according to the mainstream view, because interest rates are low, this is simply not a concern. Of course, the fact that we have gone into paranormal territory in terms of pricing, that this means young people can't afford it, the average family can't afford it, and eventually we don't need a subprime crisis event to cripple this system. You came here for the truth, so let me unveil that for you. Today we're going to look at real estate. All around the world we are seeing the signs of trouble. Look at what has happened in Australia most recently. Look at all of these very vulnerable economies. And if you take Canada for instance, a country that is now completely reliant on the price of real estate going ever higher, that is never a good sign. We're going to talk about this today. I'm going to show you the information that you need to know. Let's get into it right away. This information comes from research done by Bloomberg Economics, and I wanted to show you all of the data, this article here first, then we're going to look at the infographic, which makes it really easy to understand it all. Canada and New Zealand are the most vulnerable economies to a correction in house prices. Australia and the UK also a concern. I'm going to show you the information that goes further into it. But of course, when you have these countries here that are very reliant on real estate, when you have trouble in the economy, when you have a slowdown, of course you are going to see that come up in these particular countries. We have watched these bubbles grow further and further and further. In the United States, we saw some deleveraging and some bankruptcies and foreclosures that occurred after 2009. Of course, that allowed things to be restored back down to a level that was very reasonable. Of course, they were one country that was affected by the subprime crisis, which then led out to the wider financial crisis. But then you look at other countries like Canada, Australia, and so on that really did not feel this at all. They just felt a little dip down and then they kept on running. Well, of course, these countries are now seeing the signs of what is an extremely big and dangerous bubble. Only now are they starting to talk about it. Look at the bottom, this quote I find very funny. There's a risk that a global round of monetary easing may fuel housing bubbles. While central bankers are focused on avoiding a global economic downturn, looser monetary policy could sow the seeds of the next crisis. This right here is laughable because we are already doing that today. You don't have to worry about their new easing cycle. They're already in that policy right now. So the way that Bloomberg Economics had broken all of this down is based on these four factors. These are the keys. House price to rent ratio, the ratio of house prices to the annualized cost of rent. House price income ratio, the ratio of house prices to household income. Real house prices, that's housing prices adjusted for inflation. And credit to households as a percentage of the GDP. You don't want to take that number on its own. Of course, you want to have that based on something, in this case GDP, as the amount of debt held by households compared to the total economic output. When you put these four together, you get their own statistic that they provide. I will show you the details of that in just a second. If you are looking into buying real estate for yourself, if you're looking into buying real estate for an investment, these are what you need to pay attention to. I talk about this, of course, in the Money GPS, the original book, and that is very important because when you look at these factors, you can't deny them. If you are seeing the house price rent ratio, the house price income ratio, you cannot deny this information if you base that historically in that particular area. So you might be higher, let's say, than the national average, but how is it historically over the last 30 years, 40 years, 50 years, and try to take that information and see the trends and how they develop. Okay, so here is the infographic that Visual Capitalist had done based on the information out of Bloomberg. I want to show you the details of this. It's really good the way that they explained it. If I just scroll down here, you can see the house price rent ratio. Look at Canada, 195.9. The only country higher on this list is New Zealand at 196.8. Now, while you see that rent prices are very high, the housing prices have gone even far beyond that. There is a problem though, because what we have today is that the interest rates are so low that people are thinking to themselves, well, I could take on this amount of debt, but it's not a problem simply because I'm going to be able to borrow it at, let's say, 3%. That's fantastic, so I'll do that. However, they're taking on this massive mortgage, and that is not going to be a good thing in the future if interest rates rise, if they run into problems themselves. There is a lot of debt that they have to hold on to, and this is a problem not just in Canada, but of course in these other countries as well. Australia on the list. However, their homes have come down in price quite a bit. Look at Perth, look at Sydney. These cities have been hit very, very hard. I think Perth is actually in a bear market, of course, but we'll have to look further into that in a separate video I will do on Australia. House price income ratio, you could see again Canada near the top of the list, 155, New Zealand 156. This just shows you again another statistic piling on. Let's go through this quickly. Real house prices, Canada again near the top, looking at 124, New Zealand 121. We also have Portugal, Ireland, and the Netherlands coming up in here, just showing you how far these prices have come in this short period of time. It's there's a lot more detail in there, but you got to read it for yourself. We don't have time in this video. Credit to households as a percentage to the GDP. Again, Canada near the top of the list. Australia comes up here really high. Switzerland as well. Look at the bottom. Canada still makes an appearance near the top with a debt to GDP ratio of 100%. It's the only country to appear in the top 5 ranking for all of the bubble indicators above. Congratulations to Canada. My goodness, it is going to be a huge issue in the near future. People are so indebted and they have no idea. If you ask a Canadian right now, 99% of them would say that housing prices will go up forever and ever, and they couldn't be further from the truth on that one. Oh, but don't worry, we'll never have another subprime crisis. We're never going to have another issue like we did in 2008. No reason to worry. Waterstone Mortgage, a national lender based in Wisconsin licensed to sell in the 48 states, announced Tuesday that it is now lending to borrowers who do not have a credit history. That's right, who do not have a credit history. They're going to look at bills that you have paid. As long as you have paid them on time, you are then able to borrow lots and lots of money. This is all part of the same scam and schemes that we've been seeing over the years, all different ways for people to borrow when they perhaps shouldn't be able to. How about this? Looking around the world, Greenwich property sales dropped 20% in a year. If you look at the chart associated with that, you can see what has happened. This is going on in the UK, of course. It's also happening in places like Australia. We are seeing it in Canada and other countries that are watching as the prices are simply too high for people to afford. There are tensions that are rising globally, and of course we see the global economic slowdown that is taking effect, not just in certain places, but it's pretty much everywhere at this time. You do see pockets that are performing well, but in general, the majority of the places are not seeing the prosperity that we once did, let's say in 2017. Total sales of Florida homes to foreigners down 50% since 2017. This is a place that I find to be a great indicator, because a lot of times people are buying up investment property in Florida because they're either trying to buy a vacation home, they're trying to buy a home as an investment, but this happens to be a place in the last financial crisis that was very good to watch, because we then saw the vacancies taking place after, and that tells you people are simply dropping off their keys and they are abandoning what was thought to be such a good investment at one point. This is the chart associated with that disappearing demand. After a record 2 years ago, foreign purchases of U.S. homes have fallen sharply. So that just shows you the details there. The magnitude of the decline is quite striking, implying less confidence in owning a property in the U.S. There is obviously the issues of the strong U.S. dollar. You're seeing the global tensions that are happening right now with China. A lot less money is flowing in. But it's not just for foreigners, of course, and it is not necessarily at either the low end or the high end. You're seeing it pretty much pervasively. Real estate in the Hamptons had its worst spring quarter in 8 years. And I've been showing you this, of course, because you see people that have multi-million-dollar properties and they're just sitting there for eternity, it seems. It gives you some examples here, but there are places that were cutting their prices by 50%. They were listed at a certain high number, let's just say make up a number of $100 million, then it's $50 million. I mean, we are talking about huge, vast markdowns in prices, okay? We're not talking about Walmart's rollback here. This is a very significant drop, and that shows you even people at the top of the food chain are actually feeling the same burdens right now. Steep slowdown projected in home improvements. This is actually really interesting. Growth in residential remodeling spending is expected to slow considerably in the middle of next year, according to our latest leading indicator of remodeling activity. This projects that the annual gains in homeowner expenditures for improvements and repairs will shrink from 6.3% in the current quarter to just 0.4%. That tells you right now that they are moving to a standstill. Okay, there is no money left in this case here, but we have interest rates at record lows. If the central bank decides to cut interest rates, then the commercial banks will then follow suit. But it's still not enough, because right now today you are watching interest rates, mortgage rates at 3-year lows. That's not helping the market move, because something else deeper is going on, and you're not going to fix it by cutting interest rates 25 or 50 basis points. And to finish off the video here, you can see the leading indicator of remodeling activity, second quarter 2019, and clearly this has gone way down in this period of time. What has changed in between, let's say, 2018 and 2019 at this point? Of course, we are not looking at the details that are being outlined here in the typical GDP unemployment numbers. No. We are starting to look at that second and third tier for our indicators to put the pieces together ourselves and be able to determine what's going on. I'm going to end the video there. If you found it informative, you got to hit that thumbs up button. When you do so, you're supporting this channel, so I do appreciate that very much. If you want the financial education you were not taught in school, these 2 books have everything you need. All the indicators, all the data, all the history, everything from A to Z is in these 2 books, okay? So definitely want to read both of them. For $30, you get to know everything, and you will actually be able to ask the right questions. If you have somebody managing your money, you're going to be able to ask the questions that you need to know. Check them out at the link in the description. If you want the audiobook, that's available at themoneygps.com. Wait a second, don't go anywhere. Have you seen this video yet? If not, definitely you need to watch it. So click on it and I will see you there.